Even with the Dow down 1,000 points, our next guest believes that the outbreak of coronavirus has not been priced into the market to a great extent. Truist SunTrust Advisory's chief market strategist, Keith Lerner, joins us now. So, Keith, are we still in a bull market?
I think we are, but the first thing I want to say, Jennifer, last week I was on the show, 2 weeks ago, and you said it was such a boring day when I was on. I think you jinxed this market.
You're blaming me. It's the media.
Well, I'm just saying I'm looking at the evidence. But,
I'll take it.
To your question, I still think we're in a bull market, but we did at the end of January, we downgraded our short-term equity outlook to neutral. And part of that was before the coronavirus, we looked at the setup and said, one, we've had a big run-up about 6 months before without a correction. Normally you have a correction every 5 or 6 months on average. We were at cycle highs as far as valuations. And the one thing that bothered us a little bit was just the sentiment was pretty frothy. The amount of downside hedging or demand for downside hedging was the lowest in several years. And that's typically the time when the market wants to give you a gut check. So you layer on the coronavirus uncertainty. And to be fair, we did that in late January. The market went back to new highs. And it was surprising to us to see market go back to new highs. And I think what we saw over the weekend is people saying, okay, there is some uncertainty about this. This is going to slow down this modest uptick in global growth. And the market is basically bringing down valuation. So I do think this is a correction. I do think it's in a bull market. I do think this has further to go as far as at least time and probably price as well.
And, Keith, I'm just curious, your view on I guess we call it the character, the structure of this market, and the speed of the move, because we're down now almost 5% since Thursday, which is a pretty swift move. And we've seen this movie before. I mean, this is how the market behaved back in August when we got the yield curve reversion. This, of course, is how the market behaved at various points throughout 2018. Is this the kind of behavior that investors need to be prepared for in the modern market, where you go in with a sell program and you're looking at the big guys today, they're all off 4, 5, 6% in a flash, and maybe that's the whole move, but it's certainly scary when it happens.
That's right. And we, like you said, with 60, 70, 80% of daily trading happened by computers. That is part of it. The other side of it, which you just mentioned, which I think is a great point, is the concentration risk. With so much money in these really big capital liquid names, when they start to break down or break through some technical levels, you could get a flush pretty quickly. So that is part of it. I will say it's not just a negative, because that can create overshoots as well. That happened in early 2018. As an example, that can provide a buying opportunity. I would just say from our perspective, when we look at this, these kind of corrective periods, they tend to have a time element to it. I do suspect as headlines become more favorable or less favorable, you'll continue to have these kind of ricochet movements. But to us, I think I heard you in the prior segment, we're only back to where we were on December 31st. And sentiment is now just starting to correct from extremes in our point of view.
Hey, Keith, what do you look for? What would you look for to consider, to sound the all clear sign here with this coronavirus?
Yeah, well, there's never an all clear in anything. Unfortunately, we always work in uncertainty. It's really what's priced in. So the one thing with the coronavirus specifically, why the market initially looked past us, was the growth in the coronavirus cases in China was declining, just like it had done with SARS or Ebola, that type of thing. So you want to look at is the growth, not the absolute level, but the growth, is that being reduced over time? And then you also want to see how much this spreads. But more internally from the market, what we'd like to see is we want to see more of a spike in 20-day lows in the market. So a lot of indiscriminate selling. The percentage of stocks that are above, say, a 50-day moving average gets down to 20 or 30%. And then you want to even see more climactic volume. Today we had over a 90% down day. That's the beginning. And the last part I mentioned is just a kind of a time element, more of a back and forth on this to show more stabilization. And again, it's just too early for that after a day or two of selling. We just made a new high last week.
Right.
I know, to put it in perspective, it was not that long ago. So what now? Let's put it just in the time frame of this week. Does coronavirus own this market for the short term? And I ask that because we also have political events happening, a debate, a South Carolina primary. We still have economic news to come out. It's the tail end of earnings season. Or is this a market that is just going to react to coronavirus?
I think the coronavirus will stay in the headline because that's a big reason for the sell-off today. I do think as we get through March, the election side will become more important. We've been of the view this year that we were going to have these step backs, partly because of political uncertainty. What's interesting right now is as you look at the market odds of, let's say, Bernie Sanders, his probability of becoming the Democratic nomination, that's gone hand in hand with President Trump's reelection probabilities going up higher, at least from the prediction market, not from our view, but from the prediction market. And I think investors I talk to, they feel very confident that Trump will be reelected, and they think that's a positive insofar that taxes will stay low, regulations will stay low. However, from our point of view, again, a market point of view, is at some point, there's going to be a run by a Democratic side, and that confidence will likely be tested, which will inject some volatility and some downside volatility in the market. But I think in the near term, coronavirus is one, and the election side will be two.
And Keith, just quickly want to ask you about a note you guys put out recently. Maybe a bigger picture view here, but certainly you guys are getting questions about tech bubble 2.0. What's the deal with all these leaders? And you guys pretty much debunked that. Just break it down for us quickly, the thesis on why these big leaders are really not exhibiting the same behavior we saw 20 years ago.
Yeah, the one thing I will say, there's pockets of that euphoria and those excesses. But when we look at valuations for the broader sector S&P, it's less than half it was back in 2000. If you look at the relative performance or the absolute performance heading into the tech bubble, you went up over 100%. The performance over the last 12 months has been half of that as well. And then this time we also see the big driver of earnings this cycle has been the technology sector. Back then, a lot of companies didn't have any earnings. So we think it's a lot different. We do think things got extended short term, and that's why we're seeing part of this pullback. And there is certainly concentration risk, but we think the fundamental backdrop is just much stronger than it was back then.
Keith Lerner, always great to have you back on a day when the market is moving, and even when it's not. Truist SunTrust Advisory's Chief Market Strategist. Thanks so much.
Thanks so much for having me on.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.